Welcome back to the Property Corner. Today we're going to be looking at renting versus buying. I see a lot of people discussing this online, but very few people from industry. It's usually someone with some sort of a financial background or fintech background or fintalk background making recommendations in the property space. And I thought I'd use some actual figures from the past 15 years of experience and show you which is the better option to execute. So stay tuned while we unpack this in today's episode. So recently, there's been quite a lot of debate about this online. Platforms like TikTok, Instagram, where sort of it's easy to share your opinion, have become a place where figures are often untested. And I want to make use of actual hard figures that I've gathered from the last 15 years worth of experience, and also with systems that we have access to be able to calculate and do a analysis as to what's the better option. The argument is usually that as a property owner, you incur more costs and that a tenant will be able to rent for less money and invest the difference. So, to put that in practical terms, I've taken an example where you purchase a property for about 3 million Rand and you have additional monthly costs equating to about 5,000 Rand. Let's talk roughly. So that would mean the property is going to cost you 35,000 Rand a month. The equivalent property would be rented out for about 22,000 Rand a month, and you wouldn't have any of the additional costs such as levies, rates, insurance, maintenance costs, or any of those. So the 22,000 Rand would be the all-in costs, and you would effectively be able to save the difference between the 22 and the 35. And that's usually the argument, to say, well, why should I be paying 35,000 Rand a month just to call myself a homeowner when I can actually spend 22,000 Rand and save the other 13,000 Rand? To do exactly that, I've enrolled the help of AI. So I've used Grok to do some calculations and analysis on this subject for me. And I'll share some of the inputs that I've prompted and the background as to these calculations that we've done today. So first off, we have to deal with a couple of assumptions that we've needed to make in order to compile this analysis. The first one is the purchase price. So I've used a project that we are currently running, Stone Pine Crescent. It is a typical homeowner suburb where people would buy to live, but it is also an area that has a strong rental demand. It is a typical property that I would invest in, and I myself, in fact, have invested in. A purchase price for a house at Stone Pine currently sits at about 3 million Rand. The average the average interest rate that we are seeing on bond approvals, if you were to take 100% bond, is 10.5%. That's prime minus 0.5. Very achievable in today's market. Looking at a loan term of 20 years, and then your monthly installment equates to, where's that actual figure? About 29,759. So let's, for lack of rounding, take it to 30,000 Rand. Other assumptions that we need to, or factors that we need to take into account: bond registration costs of 53,000 Rand up front because it's a new property. You're not paying any transfer costs. And then, so that would deal with the sort of once-off 3 million Rand purchase price plus the bond registration costs, put your total investment in at about 3 million and 50. You've got a 20-year loan term, as we've said, at prime minus 0.5%. Now, actual costs of owning that property, I've looked at my property, so I've got the actual figures. Levies, 1,900 Rand a month. Rates, 720 Rand a month. Insurance, 600 Rand a month, and maintenance costs, about 5% of rental income. Remember, because this is a new property, maintenance costs should be quite minimal, but despite that, we still make provision for maintenance costs so that when you are faced with maintenance expenses, be it in year 5 or 7 or minor things along the way, you have some form of provision for that. That's sound and good sort of investment strategy and something that you should be doing. So in year 1, if you take the mortgage installment along with these additional costs of home ownership, that property will be costing you just over 34,000 Rand per month. Now let's go over to scenario 2, where you would be the tenant. So this is usually where the argument for renting, sort of gains its traction. because in year one, you'll be paying rental of 22,000 Rand a month, and you will then have 12,000 Rand a month to invest in some form of an interest bearing account. Often things like unit trusts and some other form of investments are used as the vehicles to host this money. I've looked at the highest yielding risk-free investments that are currently in the market at ABSA, and they are offering you, let's just have a look at what that interest rate. It works on a tiered sliding scale. So depending on how much money is invested, it would range anything from about just over 7% up to about 7.5%. So that is the interest that you would be earning on those savings. As I've mentioned, as the balance increases, so will the interest achieved. And I've applied that over the entire period. So yes, in year one, you'll be saving roughly 12,000 Rand a month into the savings account. Right, now we need to start looking at the projections. So I've taken our last 15 years worth of statistics in our business, as well as reports that are available to us through systems like Lightstone, where we can have a look at historic property pricing, growth, and apply them. I'm going to use the area statistics that I have experienced in this area where we're trading. And we've seen property value escalations of 7% per annum on average over the last 15 years. Rental escalation sitting at about 7.5% on average, and expenses climbing at a quicker rate at 9% per annum. You might ask the question, why are expenses climbing faster than income and property values? Remember that these are aging areas, so maintenance costs are starting to creep in the areas as a whole. And besides that, there's been quite a lot of legislation changes in the space of levies, how reserve funds need to be managed, the implementation of special levies and things like that. So levies have seen quite a big jump over the past couple of years. And then just in line with good practice, I've allowed for the expenses to escalate more quickly than the income. The city of Cape Town especially is talking about a 20% increase or 17% effective increase on property taxes in this pricing segment. So I think it's realistic to be putting this expense escalation at 9% per annum. So one part that I often see being neglected is the fact that at some point in time there'll be a crossover where the property owner is actually in fact paying less than what the tenant would actually pay. I've projected that to be in around year 10. That's when the buyer's costs fall below the costs of renting. At that point in time, the buyer saves the difference between their costs and the renter's rent into a savings account in the same way that the tenant has been doing from year 1 through to year 10. Remember that the property buyer is paying a fixed monthly installment of around 30,000 Rand a month, but the cost component, which started off at 5,000 Rand just under 5,000 Rand, that has escalated over time. But the mortgage bond component has remained fixed, whereas the tenant might have started off on a lower base of 22,000 Rand a month. That has been increasing at about 7.5% per annum continually from year 1 through to year 10, and will continue to do so from year 10 through to year 20. So that leaves us with one more thing to do, the final net worth calculation. This is where things become very interesting. So the buyer's property value would have escalated from around 3 million Rand to 11.5 million Rand. The loan balance would have come down from 3 million Rand to zero. It would be fully paid after 20 years. But from the year 10 point onwards, they would be able to save in year 11, 2,763 Rand a month. But that would escalate over time. As we've said, that would average to around 5,500 Rand a month. But we've done that calculation, adding in the interest, compounding it, applying the different tiers to ensure that it's accurate. But in addition to the 11.5 million Rand that the property is worth, there would still be about another 1.14 million Rand worth of savings, bringing a total net worth to just under 12.7 million Rand. The renter, on the other hand, would have only had the opportunity to save from year 1 through to year 9, about 12,000 Rand a month in year 1, decreasing annually until a point in year 10 when that crossover happens. At that point in time, they would simply be able to accumulate interest without any further contributions. So bringing the total net worth to 3.16 million after the 20-year period. To put that into perspective, in year 20, the rental income would be 93,000 Rand a month in comparison to the 3 million Rand that you have saved up. The interest on the 3 million Rand savings that the renter would have would not even cover 1/3 of the monthly rental that they would be required to pay at that point in time. So in essence, why does this happen? Because the buyer's repayment is fixed at around 30,000 Rand a month, and his expenses escalate at 9%. But the renter's rental, even though it starts off a lower base, escalates at 7.5% per annum up until that point of crossover that we've discussed. So what does this mean? It means that there's a difference of about 9.5 million Rand in net asset value after the 20-year period. And this is largely due to the property's appreciation and earlier savings from the crossover point. So when looking at this and deciding whether you should be renting or buying, you can often be fooled into thinking renting would be the better option because you look at the shortfall in year one that you could potentially save, and you apply that to this whole 20-year loan period. But remember that changes. You'll only be able to save 12,000 Rand in year one. From year two onwards, you'll be saving less, and so on, up until the point that you aren't able to save anymore because the difference between ownership and renting reaches that crossover point. Another thing that the proponents of renting very often neglect to mention is the fact that they are assuming that someone has the purchasing power to buy for 3 million Rand, but then opts not to do that through choice and opts to rent for 22,000 Rand a month. So if you think about this rationally, to actually be in that position that the renting proponents propose, you would first off need to be able to afford 35,000 Rand a month, then choose to pay 22,000 Rand a month, and be disciplined enough to pay the 12,000 Rand year one rental difference into a savings account and continue to do so over that first 10-year period. Now, even if you do that, even if you make every one of those conscious decisions and you're disciplined enough over that 10-year period, you would still only be in a position where your net worth is not even 3.2 million. Whereas if you had bought, 12.6 million, that's a 9.5 million Rand difference. That's substantial. That's life-changing. And from that point in time, very often, you need to start thinking about retirement planning. And property ownership in South Africa forms a large part of retirement planning because you are able to sell that more expensive property, buy something cheaper, live on the difference. You could rent this property out and then go and rent something cheaper for yourself. In doing so, you would not only generate rental income, but you would also have the protection of capital appreciation over time. Whereas the renter in 20 years' time will simply be paying 3 times what the equivalent interest income would be at that point in time, and will have no way to continue funding the lifestyle of the 3 million Rand property. So what do we take from this, and how do we close? You may be renting. You may be sort of caught in this rental cycle and wanting to know how to get out of it. And the most important piece of advice that I could give you is to live within your means. Yes, there's very often the case where someone is earning a good income, driving a nice car, and they are choosing to rent simply because the bank's 1/3 of gross income rule, the Credit Act, actually prohibits them from purchasing a property in an area where they would like to stay. So they lose hope and they lose faith that they would become a property owner and end up spending that money, instead of saving, spending that money on a sort of short-term gain, whether that be nice clothes, a new car, whatever, and lose hope of becoming a property owner. This is a downward spiral, and one that can become very dangerous over time. If you look at this analysis that I've just shown you, you'll see the importance of property ownership, and why people like myself that are trading in this industry and are helping people achieve those goals would never veer off from this scenario. Building property wealth and planning for your retirement is something that you need to be thinking of at a young age. Property and time does the heavy lifting for you. You need to understand how gearing works. You need to understand how affordability works and what you can do. Just get into the market with something, whether it be something small, whether it be something that you're not willing to live in. Get that property purchased, and you will see how quickly your circumstances will change if you start building equity and you start being disciplined and being focused. I cannot stress enough the importance of being a homeowner at a young age when the differences are big. It is hard. So adjust your expectations. Look at something that you can really afford, but get that foot into the market. It will only become harder to enter at a later point in time. So I hope this has debunked some of the myths that are out there and really silenced some of the misinformation that's being distributed. And I hope it's opened your eyes to the reality of property ownership.